Giving money to charity always makes sense, right? Because it's a huge tax write-off. How can I maximize my charitable contributions? These are questions I run into all the time around charitable contributions, and there's a lot of confusion in this area. So I wanted to record a quick episode today to discuss, first of all, how deductions work in general. We'll talk about the tax code, and then we'll look at the 2 or 3 tax efficient strategies that we can use to give to charity to make sure that our dollars go the furthest when we are giving those to charity. So let's get into it. Welcome. I'm Erik Baskin, an Air Force Academy graduate, turned veteran entrepreneur, and certified financial planner. I help military families and veteran business owners achieve financial freedom. Okay, first off, if you do not give money to charity for whatever reason, no judgment whatsoever. When I bring new clients on, I always ask this question. It's never out of judgment. It's only because I want to know if that's important to them, because there's some tax smart things that we can do there. If you're not giving to charity at all, don't worry about this. This is giving $1 away to charity to save 30 cents in your taxes you're losing money. So anyone who gives money to charity, whether you're doing it in the most tax efficient way possible, we'll talk about that, or you're doing it in a tax inefficient way, you're losing money regardless. So it has to be something that's important to you to even engage in this thought process and this discussion. So assuming that you give money to charity at some level, let's talk about how deductions work. So you may be aware that there's a standard deduction that everyone gets to take no matter what is going on in your financial situation. For 2025, that's $15,750 for single filers and $31,500 for married filing jointly. So we have to clear that amount for our deductions at all, our charitable contributions, to be counted at all in our tax return to help us out in any way. Okay, it's gotten easier to clear those deductions in years going forward, and I'll tell you why. So typically, when we think about the standard deduction, for us to be able to itemize and not take that standard, if we're a married couple, we need to be over that $31,500 mark. So what are the items that would get us over that? There's really 3 main categories. 1, charitable contributions. 2, mortgage interest. So the interest that we're paying on our mortgage, not the principal. And number 3, state and local taxes. Now, until the One Big Beautiful Bill Act, affectionately called OBA, was passed, we were only able to deduct $10,000 of state and local taxes. That has now been expanded up to $40,000 of state and local taxes for those that have a lot of maybe property tax that they're paying on their house they own, or have a very high income tax in their state. Now we can deduct up to 40 grand. So that certainly has helped. Other things that the IRS has done to change with the One Big Beautiful Bill Act, that expanded SALT deduction is effective this year in 2025. Starting in 2026, for those that are not itemizing, it allows us to deduct up to $1,000 for single filers and $2,000 for married couples of charitable deductions, right? So outside, if we're taking that standard deduction, we actually can do $1,000 for single and $2,000 for married. If we are itemizing, they actually made it a little bit harder. Now there's a 0.5% of AGI floor. So if we make $200,000, 0.5% of AGI is $1,000. That first $1,000 of charitable contribution does not count towards that charitable bucket. So a couple nuances there both of those nuances are starting in 2026. So those are on the horizon starting next year. So bottom line, little giving here and there doesn't really move the needle much. If you are taking the standard deduction, kind of good news for you with the OBA, you're able to take $1,000 or $2,000 no matter what. But if you want a significant charitable contribution, let's say $5,000, $6,000, $7,000 a year, a lot of people are giving to church, whatever organization it might be. We're going to have a really tough time unless we live in a high income tax state. We have, lots of mortgage interest that we're paying. We're going to have a hard time clearing that $31,000 for a married couple to make it make sense to itemize and actually get something out of this charitable contribution. A lot of people are still going to be taking that standard deduction and probably just getting that $2,000 charitable contribution for non-itemizers. Okay, so now that we have the background on how the tax law works, how do we get over that standard deduction barrier to actually get these charitable contributions to help us out if we're giving to charity? Assuming that's true, we want to give 5, 7, 8 grand, whatever it is, 10 grand a year to charity. How do we do that? Well, strategy 1, the simplest, is bunching those deductions into 1 year. If I want to give $10,000 a year over the next 5 years, I could give $50,000 this year. And assuming I have that money or that stock set aside, we'll talk about the stock in a second with the donor advised fund, but assuming I have that money, giving it now in this year allows me to get over that hurdle. Let's say my mortgage interest is $15,000. My state and local tax is $5,000. So I'm usually at 20 before charitable deductions, charitable contributions. So if I make a $10,000 charitable contribution, it's going to put me at about $30,000 every single year, which is right below that $31,000 for married filing joint. I'm going to be taking the standard every single time. Now, I could say in this year, if I have $50,000, I could give 50 this year. So instead of being at 30, I would be at $70,000 of itemized deductions this year. It would make sense to itemize. I'm then getting a tax benefit out of that giving. So I'm bunching that into 1 year to get that tax benefit and get over that standard deduction threshold. Another strategy, so the second strategy that kind of goes along with this first one, is using a donor advised fund. And I've talked about this on a previous episode. I'll put a link to it in episode 37. I go into this in depth and how this works. But how it works, instead of giving cash or instead of spreading out those gifts, we are giving appreciated securities that maybe have a large capital gain inside of them into what's called a donor advised fund. A donor advised fund is a wrapper that basically the second we give it to that donor advised fund, there's no taxable gain on that money. The entire value of that stock is given away. We're able to take a tax deduction right then and there. And then we, on our terms, over a period of months, we could do it immediately. We could do it over a period of 10, 15 years, whatever we want. We get to invest those funds in the donor advised fund, the DAF, and then write checks out of the DAF to any organization that we want, any charitable organization that we want. So they're super, super powerful, especially for those that have built-in capital gains. Maybe they've got some old NVIDIA stock or something that's gone up crazy in the recent years, and we're giving to charity. This tends to be a home run for families like that to make sure that maybe they're diversifying out of a concentrated position while also fulfilling their charitable contribution goals in a really, really tax smart way. So this can be a super, super powerful strategy. I do it with several of my clients. Okay, the third strategy is a qualified charitable distribution. So QCD. This is for those that are 70 and a half or older and have an IRA. They can give directly from that IRA, which is pre-tax, right? Traditional, we're talking about money that hasn't been taxed by the IRS yet. We're taking that money and we're giving it directly to charity. So can be super, super powerful because a lot of times those individuals at 70 and a half might have large IRA balances. They're going to be subject to required minimum distributions where the IRS is going to come every single year until their death and say, hey, you got to give us a certain percentage of this account. This tax bill is coming due. We're calling you on this. You can say, no, thanks. I'm not going to give that to you. I give to charity a ton. Instead, I'm going to write a check directly to charity out of this IRA account. Can be super, super, super powerful. You have to be 70 and a half, and we can give up to $108,000 in 2025 per spouse out of that QCD. So again, those that are giving to charity already have an IRA are at this age, kind of a no-brainer to do it out of your pre-tax account. We're getting a tax break on that naturally because we're giving money that has not been taxed yet. As a bonus, this also counts towards those required minimum distributions that you're going to be subject to in your 70s. It also lowers your AGI, which can help reduce taxes on Social Security or Medicare premiums. So super, super powerful for those that have portfolios that are significant, that are pre-tax and are 70 and a half or older and give to charity. Okay, so let's wrap it up. Let's kind of summarize what we talked about. Know where you sit with that standard deduction. What is everything added up? Are you close? Do you give to charity in the first place, right? It's got to make sense for you to even talk about this. Take a look. Do we have some appreciated securities or a donor advised fund might make sense? Or just simply bunching gifts into 1 year? If you're a little bit older and have that large pre-tax balance, maybe using QCDs in your 70s might make a lot of sense. I would also just zoom out. I would say generally in tax planning, I say this all the time, take a look at your tax bracket. Where are we this year? Where are we maybe going to be in the next 5 to 10 years? Are we in an inordinately high income year? Well, then bunching deductions might make a lot of sense, or doing a donor advised fund this year might make a lot of sense. If we're in an inordinately low income year, like we change jobs, something like that, these strategies don't make as much sense because we're in a lower tax bracket. We're going to get less bang out of our buck, so to speak, for that tax strategy like a donor advised fund. So just zoom out, always be thinking and looking, where am I now? Where do I think I might be in the future with my career and income goals when it comes to tax brackets? So I hope this was helpful when we're talking about how the tax code works with charitable contributions and getting over that standard deduction hurdle. And there's a couple really good strategies out there for those that want to support organizations that are important to them. Let me know if you have any questions. We'll be back in a couple weeks. Thanks for being here. Appreciate it. Thank you for joining us today. Do you want the exact financial planning framework that I use with clients? Go visit baskinfp.com where you can grab a free download of the ultimate military and veteran financial checklist to give you the bluff on what you need to be doing to manage your finances. We'll be back with some more content to help you on your journey to financial freedom. See you then. This is a friendly reminder that the podcast is general and educational in nature and does not constitute tax, investment, legal, or financial advice with respect to any particular individual or taxpayer. Please consult with your own tax, legal, financial, and other advisors regarding your own unique situation.